Okay, where we didn't get to yet is the death of the TFSA holder. There's a couple of things to look at here. Okay, so the first is, yeah, it can be, and there's a big difference between getting this right and not getting it right. So the TFSA is always tax-free as long as it's a TFSA. Okay, so here's what happens. I have somebody who dies with whatever $75,000 in their TFSA today, okay? And we've named a beneficiary, okay? And I'll do the rest of this in a second here. I know where you want me to go here, Todd. So we've named a beneficiary, okay? What happens is that beneficiary gets the $75,000 tax-free. Okay, and like most beneficiary designations, it's going to bypass probate. And bypass any creditor claims of the deceased. Okay, now that being said, any unused room is lost. And what you may very well have, and this can happen with mutual fund accounts, and in a very volatile year like this, you can have this kind of thing happen. So let's say that this person died we'll have them die about the 10th of April, I think was a pretty good bottom here. So they died 10 April of 2020, okay? They're invested in mutual funds. So that does not end, that stays invested after death. Everybody agree with that? That amount stays invested, that's how mutual funds work, right? That's one of the advantages of mutual funds. And let's say it takes the investment dealer 2 weeks to pay this to the beneficiary. Exactly that, Todd, right? So any gain that happens in the interim, okay, I hope so too, Paul, yes. Any gain in the interim is taxable to the beneficiary as ordinary income. Okay, that's good. So for that time, it doesn't have TFSA treatment. Now, once the beneficiary gets it, then it's a different story. Okay. Yeah, technically that's true too, Todd, right? However, the advantage for the successor annuitant, of course, is that we have a much better treatment on the other side of this. So I can name a spouse as beneficiary. It's perfectly fine. It's just not the right thing to do. So my spouse can be named as beneficiary. However, what I should do, as Paul and Todd are suggesting here, I should name my spouse or common law partner as the successor owner or successor annuitant, depending what province you're in, the language changes, but it's the same thing. And it doesn't change what I have in blue down below to Todd's comment. What it does do is that means the $75,000 goes into my surviving spouse's TFSA. And basically now that person has a larger TFSA of their own. So it allows them to really have a double TFSA if you want to look at it that way. However, it's only available for spouse or common law partner. Okay, that's good.
So Jason, if somebody was close to death and they have a spouse and they haven't maxed out their TFSA, it might be worthwhile maxing out their TFSA, and then upon death, that money rolls over and it increases, you know, what the other spouse has in their TFSA.
And part of the reason that that's true is also because no unused room carries over. And on top of that, there are no post-mortem, unlike with the RSP, there is no post-mortem spousal TFSA contribution. Okay, so yes, exactly. That's the way to do it. If you have spare cash laying around, even it might be worth it, depending on the circumstances, to dip into your line of credit a little bit to max out that TFSA. Okay. And so, Mark, if your client who you helped out with that subsequently remarries, they could do the same thing again, right? So you could keep doing that. Okay. Yes, and there are some very elegant TFSA strategies here. I know very common, for example, to see people who are working with financial advisors and have RIF withdrawals larger than they need, use that to fund a TFSA. I know there's a strategy some people use where instead of waiting until December 31st to make their RIF withdrawal, they do it on January 1st and put the money into a TFSA, because that year of growth is going to be tax-free now instead of tax-deferred. Yeah, exactly, Mark. Get that TFSA maxed out, right? Okay. Perfect. Now, just a couple other TFSA rules to mention. So it is now okay. This used to be sort of a gray area, but it is now okay for a spouse to give their spouse money to invest in a TFSA. As long as it stays in the TFSA, there's no attribution. Stay in the TFSA. We used to have to jump through some hoops to make this work. Now it's just simple. Okay. The Income Tax Act was changed to acknowledge what was reality here. Yes, there's no direct way to hold rental property in your TFSA. Okay. And yeah, and the other thing I wanted to mention ties into the comment that came up before. I think Mark made this comment earlier. So your TFSA is designed to hold investments. No, so you don't have to do that anymore, Mark. I could literally write a check into my spouse's TFSA as of the 2019 federal budget that got fixed, because everybody knew what was happening, Mark, right? So we just don't need to worry about that anymore. That's good? Yeah. Okay. So the other thing I want to mention here is, yes, your TFSA is intended for investment activity, okay? Not business activity. Okay, so if I put some money into my TFSA, I put cash in, and I make whatever, let's say 4 or 5 trades this year, and that's routine for me, that's normal. Does that look like an investment or a business? Yeah, that's investment activity, right? And that's almost certainly where that's going to be considered as far as CRA looks at this. That's investment activity. But now, what if I make 40 or 50 trades this year? Yes, I 100% agree with that, Paul. Yeah. What if I make 40 or 50 trades and I use some derivatives in here? Okay. I have a hefty portfolio of research. Maybe I even pay for research. I spend a couple hours every day doing this. Okay. Now, what kind of activity is this? Yeah, now it's a business, and any activity in here would no longer be tax-free. Yeah, I would suggest that these things probably make it a business, Todd. If this is really what's happening, that's probably enough for CRA to consider this a business. Okay. In fact, there's even a case that went to tax court with a fellow who carried the CFA designation, who was exactly doing what you're suggesting here, Mark. He was a retired CFA charter holder, and he wasn't even day trading. He didn't have that much activity. It was like 15 or 20 trades in a year, but he lost on tax. He lost at tax court because the judge decided that with his high level of expertise, there's no way this could be anything other than a business. That's good. Yeah, it was for personal use, Mark. It was his own retirement money. Yeah. Yeah. Okay. So now it's a business. And yeah, I didn't think so either. That's why this case stuck out for me. All right. So now it's a business, therefore no TFSA. It's all taxed at, all gains are going to be taxed as business income. Okay. Good. I don't think it went to appeal, Roxanne. I think he just ate it. I mean, there is something to that, Mark. Yeah, they're not going to bother if you make $500, right? It just doesn't make sense. Okay. So yes, planning with the TFSA. It's a wonderful planning tool. And we really should be thinking about it. It's always a challenge here as to what account we're going to invest in first. Okay. So generally speaking, here's what I would say with RRSP, right? So the RRSP works ideally if your tax bracket today is greater than your tax bracket in retirement, right? That's the sort of, that's the key here with the RRSP. That's good. It can even work if the brackets are the same, yeah. Or you can actually even have a slightly higher tax bracket now. Okay, it still can work if it's slightly higher now. It's not ideal, but it still can work there. This is where you have to do the math. And I'm not going to say universally that this is true, but there are cases where you might have a 1.5 or 2% higher tax bracket in retirement, and it still makes sense to use the RRSP. Okay, that's good. So the TFSA, this is true. So the other thing I want to point out with the RRSP is it reduces your net income. Okay, and this becomes important, and this was, I think, Melanie, you asked this question earlier. We want to think about this for Canada Child Benefit. That's a key place where net income might be material, or your RDSP grants. That's another place where it might matter. It might even matter for GST credits, although I'm not a huge fan of that one. I would have a tough time supporting that, but I will say that that could be on the list. Okay, So we shouldn't, yeah, it's true, Todd. We could be thinking about OAS here. Probably you're only thinking about that for a few years, but it's a valid point. Yeah.
Yeah, for retirement, it may be better to have TFSAs and RSPs, because RSPs, when you withdraw, it's considered income, but with TFSA, it's not. So it might not push you over that threshold where you get any clawback in OAS. So in that case, TFSA would make more sense than an RSP withdrawal.
So I'm going to talk about that in a moment. What I'm really looking at here is using an RRSP contribution to reduce your net income, which could still make sense from age 65 to 70, depending on your exact circumstances. Okay. So then, yes, to your point, Todd, the TFSA. So when do we want to use TFSA? Well, generally, if we're thinking about it for retirement planning, and I don't think this is the only reason we should be using TFSA, okay? But if we are thinking about retirement planning here, you have to consider there's no minimum withdrawal. You can preserve tax favored growth longer than with a registered plan or with an RRSP, I should say, because TFSA technically is a registered plan. You have more flexibility around withdrawals. And other than, back to your point earlier, I think, Shade, it was you, it does not create income for other means-tested benefits. However, be cautious that it is an asset for provincial disability supports. Okay, so it does hurt there, but if you're concerned about your means-tested benefits, GIS would be the big one, but to your point, Todd, we could be concerned about OAS as well. Okay.
I didn't know that the TFSA affects disability support. I didn't think they look at that.
Yeah, not the income you draw, but the asset amount.
Oh, really?
Yeah, absolutely. So if you're in Ontario, for example, Ontario has a $50,000 asset limit for ODSP. If you had $60,000 in your TFSA, your ODSP would end. Okay, which is why that person would prefer to use an RDSP, right? Okay, and I mentioned this a minute ago, but I'm going to show it here. I'm not going to say that I'm a huge fan of this. Okay, yeah, exactly, Esther, 100,000 in Alberta. I'm not a huge fan of this, but I'm going to show you anyways. And I know some people are going to do this kind of thing, and I'm okay with it. If you can get your clients to play along with this, great, they're going to win. Okay, so let's say that I have a client who has let's say a $20,000 RIF minimum this year. Okay, everybody's with me here? They only need 15,000 of it to pay the bills. They have also 2 times OAS and 2 times CPP between them and their spouse. Maybe their spouse has a pension, something like that. That's good. So here's what you might do. No, that would not, Esther. That's fine. If that was your only liquid asset, you got $80,000 in your TFSA, you could have that and still collect AISH. That's fine. Okay, so yeah, they're going to lose some to tax here, Todd, right? So consider this. On the 1st of January, take $6,000 out of the RIF. Yes, that's going to be taxable, but you're going to have to take it out at some point anyways. That's going to go against your RIF minimum. And put that in your TFSA, okay? In the same investments. Don't change the investment mix here. If the investment mix was right, it's still right, okay? And what you're going to do by doing this is any investment gains in the year, you now are swapping tax deferral for tax free. So instead of a tax deferred RIF, you have a tax free TFSA. Let's say, for the sake of argument, that it grows to $7,000, just to use a number. Well, if I had that in a RIF, that really means that I have $1,000 that's going to be taxed at my marginal tax rate, maybe at death, but whatever. At some point, it's going to be taxed at my marginal tax rate, whereas in my TFSA, it's $1,000 times no tax. Is everybody with me there? Now, I think for a lot of retirees, that's going to be a lot of work, and you might not want to drag somebody through that. But if you've got your clients well trained for this kind of thing, you know, when you project this out over 30 years, right? So, you know, 30 years of retirement, I'm saving $30,000 compounded, right? That really is going to be compounding growth on that tax liability. That's potentially quite beneficial over that time horizon. Okay, that's good.
Yeah, I got a question, Jason.
Yeah.
So let's say the client takes out, it says here who has a $20,000 RIF payment. So you're just saying they're taking out 6 in January, but they still have to take out 20 in the year. Is that correct?
There'll be, so if I take out 6 in January, I only have to take out 14 more in the year.
Right. Okay. Now, if a client had only $100,000, let's say, in their RIF, and they're taking out $20,000 each year, so they could do this, would this strategy be better, or is it better that they get that pension credit, where now that they've converted this to a RIF, the client's over the age of 65, and they could get a $2,000 credit, and the spouse could also get a $2,000 credit, which is $4,000. Wouldn't that make more sense to keep it in the RIF and only take out so much, so you get that $4,000 of tax credit, or is it better to move it to a TFSA?
Okay, but if I had a $20,000 RIF minimum, I've got $700,000 or $800,000 in my RIF. Right?
Okay, that's true. But what if it wasn't a minimum of 20,000? Say the minimum was only 5,000 or 6,000, like you took out on the bottom. Would it be better still to take out more and then move it to the TFSA, or is it better to leave it in there and then get that credit each year?
So I want to point out, I'm not taking out more. Okay, I'm not increasing the amount that I'm withdrawing from the RIF. I'm only changing the timing of it. So normally, what I would see in this case is somebody would wait until December 31st to make that withdrawal, right? That's the norm that I see with that RIF. But I'm suggesting you take it out on January 1st, and then you get a year of tax-free growth versus a year of tax-deferred growth. I'm not just moving money from my RIF to my TFSA. Okay, but it's not more, Mark. I'm not taking out more. Okay, so I'll take the other 14,000 that I had to take out anyways out over the course of the next year. Okay, that's what I'm shooting for, Esther, is that advantage, right? Now, Paul, remember, sorry, just one second, Todd. Remember, to your comment about the withholding tax, Paul, is that I don't have a mandatory withholding tax if I only take my RIF minimum, right? Okay. Oh my goodness, Sherry. Yes, I would absolutely. This is the perfect example, Sherry, right? That's exactly what I would be doing. At the very least, open a TFSA, because what else is she going to do with that money? Now, sorry, Todd, I cut you off.
So I was just going to say, I have a client who's sort of doing this strategy, but she's wanting to take more and more out of her RIF each year, like $20,000, and there's only $80,000 in there. But if she can get $2,000 on the for the credit and $2,000 for her wife or for the husband, she's better off not taking out $20,000. She should be taking out less if she doesn't need the money, so she can keep getting those credits going forward as long as she can, because the credits are basically free money.
So what I would compare that against is GIS, right?
Yes.
If she's going to qualify for a GIS sooner by cleaning out the RIF, GIS is going to be most likely more beneficial than the pension credits.
But let's say she doesn't qualify for a GIS because the OAS and CPP that they both get is too high, and they won't get. I don't think they'll fall in that threshold where they'll get GIS.
If they both have really good CPP, they won't. But OAS doesn't affect your GIS, right?
Right.
Yeah.
Okay.
Okay.
I know it's math. It's hard. Okay.
But you have to honestly. I mean, that's a financial planning software problem, right? Yeah. Now, Sherry, again, in your client's case, if she doesn't have a lot of other income, she might be better off to strip out her RIF at a more aggressive pace. And again, same strategy, try and get to collecting GIS, okay? You have to take spouse's income into account, as Todd pointed out, but that can work, okay? All right. Unfortunately, it does require just doing the math, which really in these cases usually means either plugging into your financial planning software, or building an Excel spreadsheet. Okay. That's good. I don't. What do you mean by defer the RIF payment, Mark? Sorry, I'm missing that. Yeah. Right. So that's always the case. Yeah. You have to be in your RIF by the end of the year in which you turn 71, but your first withdrawal does not have to come until December 31st of the year you turn 72. Yeah. I like SNAP projections, Esther. Now I'm biased about SNAP. I happen to be friends with the principal there, but I'm a fan of SNAP. It does a good job. It doesn't do everything, but it's really good for retirement planning. All right. If I were a financial planner who didn't have access to Conquest over at IG, I would look at SNAP and Cascade FS as a couple. And I think you could do pretty much everything with SNAP and Cascade together. But ask around, okay? I don't do a ton of financial plans, Esther. And in fact, when I do my own financial plans, I always just do them in Excel, okay? That's good. Which is honestly, like it's a very clunky way to do it, but the advantage to doing it is I know what went into it. Okay. All right. And unless you do a lot of them in Excel, it's just not a good way to do it. All right. I mean, NaviPlan is okay. I'm not critical of NaviPlan. I'm not a huge NaviPlan fan. Maybe I am critical of it. I don't know, Todd. But one of the things, so at Sun, like you have a huge cadre of folks who know SVFA or NaviPlan really well, right? And that is a big advantage, just having that degree of familiarity with it. Yeah. So don't switch, right? Don't switch because of some crazy thing I said. Yeah. Okay, we already talked about our TFSA traps. So then we have to look at registered plans at death. Okay. So we're going to start with the basic here, which is the RRSP at death. And we already did TFSA. We won't bother with TFSA, What I really want to focus on here is the RRSP, the RIF, and the pension. So I'm going to start with RRSP at death. All good? So first off, with my RRSP, I can name who as beneficiary. So who can be the beneficiary on my RRSP? It's true my spouse can. Who else could? My common law partner could, sure. Who else could? My kids could. I could name Bonnie. I could name anyone. All right. So I can really name anybody as beneficiary. That's good. Okay. I mean, Roxanne beat you to the punch, or sorry, Bonnie beat you to the punch, Roxanne. So I cannot name my pet. My pet is not in anybody. My pet is in anything at law, Esther. So I can name any person, any individual, or actually corporation. I can name any person as beneficiary. Okay. So any person. Nice. All right. So, well, not directly, Bonnie. The biggest reason that that's relevant is because potentially the financial institution is going to take longer to get the money to that person. Yeah, I can name a charity, Esther. Yeah. All right. I can't actually name the apple tree, Paul. I like it. All right. So the yeah, at law. I did say at law, Stephen. All right. So wasn't it somebody on this call who said that they like their pets more than 99% of the people they meet? Was that on this call or was that on my exam prep? That's what I thought, Stephen. It was you, Bon. And I said, hey, wait a minute. I'm one of the 99% of people you know. And I got no. Yeah, just crickets, Bonnie. Exactly. All right. So I know, Stephen. All right. So, okay. So anyways, the I couldn't remember though. Then I was thinking, which class? But yeah. All right. So I can name anybody as beneficiary. This is absolutely true. Okay. If I name a non-rollover beneficiary, okay, and we'll come to the rollover beneficiaries in a second. And I find people have all kinds of problems with this. So a non-rollover beneficiary would be, for example, a sibling, okay, or an adult independent child. Okay, everybody's with me here? Then what happens is very similar to insurance. That person gets the money as a beneficiary designation. So it bypasses probate and it bypasses creditor claims. Okay. However, it still has to be taxed. So the tax burden falls to the terminal tax return, which is the final tax return that you file at death. That's where all of your last minute stuff, everything that happened in the year of death, gets dealt with. Everybody's good there? The effect of this is that it will reduce the available estate for the rest of your heirs. Now, if there is not enough money, nope, the tax is not paid by the beneficiary and it doesn't come out of the gift to the beneficiary. It's, yeah, so really it reduces the estate, Bonnie. Yeah, it's not, technically it's not paid by the estate, it's paid on your terminal tax return, which reduces the value of your estate. Okay, your estate doesn't exist until after you die. Your terminal tax return is the stuff that happens as of the moment of death. Okay. All right, so it reduces the estate for the rest of your heirs. That's true. Okay. If there is not enough money or assets available to your executor to pay the tax, then CRA can come after the beneficiary directly. So that's the only case, Bonnie, in which the beneficiary will actually pay the tax. Okay, and that's under whatever it is, section 146.111 of the Income Tax Act. Okay. That's good. So, yeah, that's right. It's in fact, this is a really questionable thing to do, Bev. Okay. Actually, maybe in yesterday's advisor.ca, somewhere I just read, oh no, Money Sense. There was just an article on Money Sense about this, a Jason Heath article in Money Sense, about not naming your adult children as beneficiary on large RIF accounts. Because you're 100% correct, Bev, just like I have here, it's still taxable, right? My last point in pink there, tax burden still there. You with me? So, Mark, this has been the conventional thinking. People used to like beneficiary designations. However, there has been a raft of court cases lately that really call that into question, including one that went to the Ontario Superior Court maybe 3 weeks ago, or that came out of Ontario Superior Court 3 weeks ago. I have a video on this, actually. I just did a YouTube video on this. And in that case, Mark, a dad had one child who was independent and one child who was less independent, let's say. And he left the less independent child as the beneficiary on his RIF. And he left no other documentation. There were no notes from the financial advisor about why he did it. And the court said, yeah, we don't think that's a valid beneficiary designation. They unwound it and put it back into the estate. Okay. Right. The point here is, Mark, that beneficiary designations, especially on registered accounts, are not actually really that strong as the law exists in Canada today. Okay. I don't understand. What do you mean by estate to the last survivor? Sorry. There was no spouse. There was only the dad and the two kids. Okay. Seg fund's a little different, Carla, although there has been a murky set of rulings by or around seg funds as well. Yeah, unfortunately, I don't have an answer for you on the seg funds question because we've had both outcomes. We've had it where it was treated as insurance and we've had it where it's treated as an RRSP. Okay. Right, right. So you're not leaving kids as beneficiaries, Mark. Yeah, okay. Well, that's safer. All right. You might end up with a little more costs because of it, but you're not going to end up with a lot more costs because of it. And that's kind of the point, right? That you can try to squeeze every last drop out of this, or you can say, hey, I know we're going to lose a little bit. Let's accept that and then deal with it accordingly and move on. I would suggest that's generally the right thing to do, Philip. I don't want to say universally. I'll go back to I know Todd gave us this once already. There's some it depends there for sure. Okay. Yeah, maybe if I have an only child, Mark, maybe then. All right. Okay, that's good. And even those cases are increasingly more complicated. Yeah, I know, but we just had another Ontario one actually, Mark, where a child who was not the child of the deceased, actually, Melanie, this is the one I sent you. Okay. You asked a question on the discussion forums, and this is a case where a girl who was not the guy's daughter, okay, but was the daughter of a girl who had been his girlfriend, but if I remember right, never the common law partner. And the courts brought her into the estate. Okay. That's good. Okay. Yeah, it really is, isn't it, Melanie? And, you know, the more of those cases you read, the less you'll ever want to give somebody a clear answer about an estate planning case. Okay. Yes, that I generally agree with, Mark. Yeah. Okay. But the number of times today when we can say always or never, I can almost never say always or never in an answer to an estate planning case. Okay. That's good. All right. So we're good with this. Oh, now so you're still going to bypass probate. So that's a little bit messy. So then we're going to look at, I'm going to erase this, and we're going to look at the rollover beneficiaries. Okay, so I have potentially up to 3 rollover beneficiaries. Yeah, and that, 20 years ago, Esther, that was really a lot better than it is today. Okay. Okay, so first off, I can name a spouse or common law partner as beneficiary. Okay. Then we're going to look at naming an adult dependent child as beneficiary. Okay. And then we're going to look at naming a child with a disability. Oh, I missed one, as beneficiary. And sorry, I also want to capture naming a minor dependent child as beneficiary. Okay, and for both of these folks on the left, I want to make sure that we know these are no DTC. For both of these folks, no disability tax credit. We're going to deal with all of our disability tax credit questions over on the far right. Okay, is that good? Okay, so the easiest one, assuming that everything goes right, is naming my spouse or common law partner as beneficiary. And here we simply get a rollover. So this person, the survivor, adds the deceased person's RSP to their own account. That's it. No room required, no tax to pay. Now, technically what happens here, what actually happens here is it's a disposition for the deceased. So that's taxable. And then it's income for the spouse, but the spouse files an election, the spouse and the executor file an election to put this into the RRSP. Okay, so we need this election. Is everybody with me here? And then you're going to create an offsetting deduction, and that then creates the deduction for the spouse. Okay. All right. Everybody's happy? So we'll talk about RIF in a minute here. They have to RIF it, in fact, Philip. Yeah. Sorry. If you die and leave your RRSP to your older spouse and they're over 71, it would have to go into a RIF. Yeah. Okay, but it's otherwise the same as what you see here. Okay, that's all good. Okay, Yeah, exactly, Paul. Yeah, very normal thing for the financial advisor to sort of take their clients through that rollover. So yes, actually, curious question here, Roxanne. Roxanne says, if I name the estate as beneficiary, can I still get this outcome? Question. And if your will, so it's very normal. If a good lawyer writes your will, Roxanne, are you with me here? If a good lawyer writes your will, they're going to include a provision in there that says, I give the executor the authority to essentially retroactively create any outcomes that need to be created to generate more tax efficiency than I otherwise have in this will. That's good. And that's going to allow the executor to say, I'm still happy to file this joint election with the spouse and create a rollover on that RRSP. Okay. Yeah, Bev, the what you're talking about, what the fund company does, that's the election. Okay. All an election means is checking something off in a box. Yeah, if no will, then forget it, Roxanne. This is yet another reason to have a will. Okay. In an intestacy, the executor has no power. And in fact, what the courts will say is, if you wanted your executor to be able to do that, you would have written a will. Okay. That is actually a very common sort of paraphrase of what a judge will say in an intestacy dispute. Okay. Either they'll say, if you wanted that, you would have written a will, or if you wanted it done that way, you would have written it into your will. Okay. So I want to just walk through a scenario with you here. Good. So in my scenario, I've got a couple. All right. I've got Helen here. Helen is, we'll make her age 70. Okay. And she's got a nice RSP. And then she's married to Daniel. Daniel's younger. He's only 50. Okay. And he is the second husband. All right. Everybody's with me here? And Helen has kids from a previous marriage. So she has 3 kids, adult children. They're all just very close to Daniel's age, in fact. Okay, so all in their 40s. Okay. So she names Daniel as the beneficiary on her RSP. She says that's going to be the most tax efficient thing. So Daniel is going to be the beneficiary on the RSP. Everybody's with me here? And then she also wants her adult children from the previous marriage to be properly taken care of. So she's going to leave them something. She leaves them her non-reg assets. Everybody still with me here? And she knows this is going to be the most tax efficient thing. Roxanne, this is kind of what you were thinking of a minute ago when you asked that question, isn't it? This is how we're going to get the most tax efficiency. Now, she doesn't leave the burden on the executor to do this. She writes it all like this. She makes it clear in her will what her intention is. Okay, so here's what happens though. Helen's 3 adult children, they do not get along with Daniel. Every time Helen leaves the room, they start berating him, making fun of him, calling him a gold digger, okay, and so on and so forth. Everybody's with me here? Okay. So then, when Helen dies, and we get all of this shaken out, Daniel says, I'm not going to file that election. Okay, so now because Daniel does not file the rollover election, what happens with that RRSP? Who's going to get the RRSP first off? Who's going to get that RRSP? In fact, Daniel will. He's still the beneficiary, right? He is the beneficiary. He gets the full amount. But now, exactly that, Philip. It's not going to happen on a tax rollover basis. No rollover, and that means that the terminal tax return pays the tax, which is going to reduce the value of the estate. Okay. So be nice to Daniel. Good. And that's why I tell you this story, Bonnie. I don't really care about Helen and Daniel, okay? But I think this is a good illustration of really what it means to be a beneficiary and what it means as far as how this is taxed. Okay. All right. So if Daniel had filed the rollover election, Sherry, then that would have created income for him and a deduction for him and a deduction for Helen. It would have basically meant that Daniel was only going to pay the tax later on when he RIFs and takes it out. But instead, he's going to get the full amount, all as a non-registered amount now. Okay. That's good. So instead of getting a big RRSP, he just gets a big pool of non-reg cash. Yeah. Yeah, exactly, Bonnie. Now, that's where we'll talk about that in a minute with the RIF. So there's a slightly different set of outcomes with the RIF. We'll come back to that in a second, Bonnie. Okay. I mean, probably the rollover is preferred, Ryan, but in this case, Daniel wins by not doing the rollover, doesn't he? Nice, Todd. There's no reason for him to put it into an RSP. Okay. Yeah, that's exactly it, Philip. Yeah. Okay. I mean, if he has income that he wants to reduce, fine. Yeah, so does he have any income, Todd, right? He's not going to get any RSP deduction limit for that. Yeah, so fine. If he has income, use that to make RSP contributions. Okay, nice. I guess we should have trusted the kids, Stephen. I forgot about that. All right. Okay. All good? Okay. So then the adult dependent child, nice, Grant, enjoy. All right. Perfect, Stephen. Perfect. Okay. Okay, so the adult dependent, actually one of the boats in my campground here is the money pit. So there you go, Stephen. So the adult dependent child is beneficiary. So this person has to earn less than the basic exemption, which is about $13,000. Okay. If they do, we can create a rollover much the same as a spousal rollover. Okay, it's really the same thing. They would inherit the full RSP. and it goes into their own RRSP account. Okay, I hardly ever see this done. This is exceedingly difficult to plan for. You really have to die at sort of the opportune time when your child's income is low. Okay. All right, then we can have the minor dependent child as beneficiary. Okay, it's essentially the same outcome, except under the Income Tax Act, and this is, I'm going to show you a couple things here. So under the Income Tax Act, the child must annuitize the RRSP. Okay, what do I mean by this? Well, they buy a term certain annuity. It pays an annual income or an income until the day before the child turns 19. And basically what that does then is it spreads the tax gain out over the number of years between now and the child's 19th birthday. Okay. However, the reality is this is probably something you're never going to see, even if you try for it, because your provincial court system is probably not going to let this happen. They'll say, look, if you're going to give this, whatever, 13-year-old a bunch of money, it's going to be gone very quickly. We can't allow you to do this. Okay? And instead, the courts will take the money and then no rollover, and instead they will invest it in trust for that child. Okay, so the child will get a small income from today until age of majority, and then they get all the money. Okay, which honestly is probably a bad outcome, but it's very difficult to really, and this goes back to Todd's comment earlier about the 18-year-old trying to buy a TFSA. We just generally don't have the provision for minor children to own sort of beneficial amounts of assets. Okay. And if we do that, Philip, that's exactly right. That would mean that it's taxed on the terminal return. Yeah. Okay, that's good. So as much as that might be what the Income Tax Act says, in practice, no. Yeah, it's not going to be a registered account, Bonnie, right? Once we pay tax on it, it's no longer registered, right? It comes out of that RSP treatment. Okay. You with me there, right? That deregisters it when we pay the tax on it.
Hey, Jason.
Yeah, Melanie.
I just don't understand how, doing the rollover and annuitizing the RSP is really like a different outcome than a court taking the money and basically giving them sort of an annuitized RSP until they're 18 and then they get all the money. It looks the same to me.
So in the top example, if we could tax plan this, right, which I said it's almost impossible to actually do. Mm-hmm. So let's say for the sake of argument, it's, let's say it's $100,000 for a 15-year-old. Is that okay?
Yeah.
Okay, perfect. So if I do the top route, what's going to happen here is we're going to have $25,000 at 15, roughly, it's going to be a shot more than that, but roughly like this. We're going to have 25K at 17 and 25K at 9. Now, depending when the birthdays fall, I might have missed a year, but you get the gist, right?
Yeah.
So really, I'm only creating $25,000 of income per year,
Mhm.
which is, you're going to pay next to no tax on that, right?
Yep.
Okay, whereas if I do the bottom option, then right here, bang, all at one time, that's where I'm going to have $100,000 on the terminal tax return. Okay, so that's all taxed, right? All at one time.
Yep.
And then 100,000, to Bonnie's point here, $100,000 goes into, so 100,000 of non-reg money goes into the trust. And now the only thing that's taxed is any investment gains on the 100,000.
Yep.
So it's really the difference between having $25,000 spread out over the 4 years or 100,000 all at one time.
Well, didn't you say though that the courts would take the money and then give them some until they, yeah, small income from today until age of maturity, and then they'll get all the rest? Like, is the courts not giving them income every year till they're
Sure,
age
but
of
that's
majority?
not taxable. That's coming out of that after tax $100,000.
Yeah. I guess I'm just not understanding why they wouldn't do the annuitizing the RSP and doing the rollover.
Why the courts won't allow it?
Yeah.
Right, because the courts are going to say, look, if you give that 15-year-old $25,000, they're going to
Okay,
use it to buy.
they give them significantly less. I guess that's what I was missing. So the
Yeah.
courts are going to give them whatever, maybe 5K or something.
The guideline is roughly, and this is rough by province. I don't know exactly what it is in Ontario, but the guideline is roughly if you have a family guardian.
Mhm.
So if you end up with your uncle, the courts are going to pay roughly half the amount that they would pay a foster parent to take care of you.
Mhm.
And they're really going to pay it to that person.
Okay.
Okay.
All right.
Do we have any foster parents on the call? I usually have in one of every 3 classes or so somebody who's done the foster parent thing, and nobody gets rich being a foster parent. All right, that's not. It's not enough money, Melanie. That is really what it comes down to.
Mhm.
It would be less money, and even if, so you're right. Like your 5,000 is probably not a bad number to start from.
Okay.
Nice bunny. Yes. Okay. That's funny. You don't get any money for that. I guess you get maybe some Canada Child Benefit. All right. So anyways, so then child with a disability, any age as a beneficiary. So once again here, we could use an RRSP rollover. Okay, that's a possibility. However, funds in the child's RRSP will wreck provincial disability support. So what do we want to do instead? What could I do here instead? That's it, exactly, Ksenia. So we could roll up to $200,000. Now you need room for this. You need room and you'll get no grants. Into an RDSP. Okay, and again, the courts probably won't let this happen for a minor child. Although it's slightly more likely here. Okay, yeah, exactly, Ksenia. Yeah, no grant because it's a rollover. So if you really want to be super efficient with this, you could roll $170,000 in keep $30,000, give that to the kid's sibling, have the kid's sibling put $1,500 a year into the RDSP, and maximize your grants. You better trust that sibling though. Okay. All right. Any questions there? This slide, remember last time we're together, I talked about the slide for RSP math being so important? That's right, don't give it to Daniel. So I know it's the end of the day and it's not maybe the best time to do this, not optimal, but it's kind of what we have to have done is to cover off a bunch of other stuff. This is a slide that you should put on the top of your pile of stuff to study. Okay. This is a really good slide for an exam writer because you get all these different moving parts, right? We have retirement planning component. Yeah. Yeah, exactly, Todd. We have an estate planning component and we have a tax planning component here. So the marriage of these and potentially a family law item as well. Okay. That's good. Yeah, if you're only going to learn one thing today, learn everything on this slide. Okay, that's good. All right. Okay, we got a little more to do. So the next we'll look at is the RIF at death. Okay, now it's essentially the same as the RSP. Okay, I just want to talk about some differences for the spouse. Okay, so here I can have one of two things. I can have the spouse or common law partner as beneficiary, or I can have the spouse or common law partner as the successor annuitant. Okay, so if I name the spouse or common law partner as beneficiary, then on death, the RIF is collapsed. Okay, and that means that we have to take the minimum withdrawal for the year into income if we haven't done so already. Remember when we move, we talked about this last time we're together, when we move a RIF from one institution to the other, the institution that's moving the RIF has to take that minimum withdrawal for the year. It's exactly the same thing here. Okay, that's good. Whereas if I name the spouse as the successor annuitant, so not the whole thing though, Todd, right? It's only the minimum withdrawal. That's all we're concerned about. So then, yeah, sure, to finish this point off.
But it's all taxed if there's no, if it's a beneficiary, then the full amount is still fully taxable. Whether you take out the minimum, they don't withhold the tax, really doesn't matter, because if it's $100,000, there's $100,000 in tax.
But we're still using a rollover here. Okay.
Okay.
So it's still a rollover
wasn't doing a
beneficiary.
rollover. I was doing it as just as a beneficiary, and all the money comes out, and there's no rollover.
Yeah, except we're still doing spouse, common law partner as beneficiary, right? So I know I showed you that we don't have to use the rollover here. That person can not file their election, but normally they're going to.
Okay, we'll just continue, and I'll see what the successor is. Okay, go ahead.
So if the, yeah, exactly, Paul. If we already did our RIF minimum, fine. Whereas if it's a successor annuitant, okay, So if it's a successor annuitant, then the surviving spouse adds the RRSP, or sorry, the RIF to their own RRSP or RIF, and we don't have to worry about a new RIF minimum until January 1st of the year following. So they're not beholden to their spouse's RIF minimum for the year of death. So you get a little more tax deferral this way.
What about age? Can you use the spouse's age with this successful annuitant? So can you keep it as the spouse's age if they were younger, or?
Yeah. So if you were already using your younger spouse's age and your spouse dies, you don't have to change when your spouse dies. Exactly right. Yeah.
Okay.
Yeah. Okay. So generally speaking, once you're into RIF country, and it's interesting, isn't it, Nicole? It's, it's not a huge benefit, but it's one of those things you get a little bit of efficiency, a little bit more flexibility on. There is some benefit to actually planning this out properly. Okay. Okay. Any questions there?
The only question I have is I thought it was the same, but I guess because I always name the spouse or the common law partner as the annuitant, I've never named them as the beneficiary. So I guess I never thought about this. So
yeah, because successor owner annuitant is definitely the best practice here.
Yeah. Okay.
Yeah. Okay. But a lot of times you'll find if you're taking over other accounts, you will find that the beneficiary is what's been done. Okay, now pensions. So the last thing we'll look at here is pensions. And I really only care because we've already done what happens if you've already started the pension. So these are pensions in the accumulation stage. So with a DC pension, super simple. A DC pension is going to be employee contributions plus employer contributions plus gains. Whereas with a DB pension, what's going to determine this value? A kind of, Mark, yeah. In your so remember, this is just going to be straight up a accumulated value calculation, right? We're in accumulation, Philip, right? Not at the, we talked about that earlier. We talked about what happens if you die with the pension already in the payout phase. We're talking about just accumulation here. So here I care about the commuted value. Okay. Okay. So in all cases, I can name the spouse or common law partner as beneficiary, and it would roll over to either their RRSP or LIRA. And this actually, Mark, if I had thought about this before, I would have known this. It would roll over to their RRSP or LIRA depending on the jurisdiction. Okay, that's what you talked about earlier, Mark, right? Because you had LIRA to LIRA here required. Okay. With any other beneficiary, I don't have that rollover opportunity. Okay, and simply it is going to have one of two things happen. Okay, it can be taxed to the beneficiaries or taxed on the terminal tax return. And this is typically a decision that the executor and beneficiaries will make together. If we can't come to an agreement, then it's just going to be taxed on the terminal tax return. Okay, and generally it's going to depend who you leave behind as your beneficiaries. So if you have somebody who dies and leaves behind, let's say 3 students, okay, probably better for them to have the income. Okay, yeah, that's exactly it, Paul. Whereas if you die and leave behind 3 working adults, it may be, and exactly what Paul is suggesting here, it may be better for the terminal tax return to have the income. Okay, and this is really an accountant's calculation. The accountant should be able to tell you this outcome fairly easily. That's good. I have seen this done wrong at least once. I actually had a friend who had this done, and the executor didn't even bother to determine which one would be better, just made an assumption. It turns out it was the wrong assumption. Okay, that's good. All right, and one more thing we'll go over today. We didn't get into the afternoon slide deck at all. What do you do? Okay, so anyways, just very briefly here. Okay, we really are going to do this but lots of good questions today, so I don't mind that. That's perfectly fine. I would rather have good comprehension, go a little slower, that's fine. Okay, so under the Income Tax Act, remember we have this provision that says whether I'm looking at RRSP or any of the other sort of similar plans, remember my RRSP limit is for 2020 for new room is 27,230. Everybody with me there? Which correlates to about $151,000 of income. 151,278 of income. Okay, so practically, and this is true for, remember, no, we're going to do that in chapter 2 of advanced curriculum, Paul. Okay. Are you hoping we're doing pipeline planning? Is that where you wanted me to go here, Paul? Okay, so this is roughly the maximum level of income at which registered plans are effective. Okay, and this is true for the RRSP. This is true for DPSP. This is true for DC or DB. Okay, is everybody with me there? So this is the question then. The question I have is, what happens if I have an employee who earns more than 150,000-ish a year, and I want to build a retirement for that person? Okay, Now, you might not feel a lot of sympathy for this problem, but the reality is that if everybody kind of uses the same guidelines that we need to retire on somewhere between 50 and 70% of our income, the amount of income you earn during your working years should still translate into your retirement needs. Is everybody with me there? Okay. So this is where we get into what are called SERPs, which is Supplemental Employee Retirement Plan. It's right up in the header. So the general concept here is, how can an employer help a high income earning employee plan for or set up for retirement? It might not be plan, that might not be the best word, but maybe set up for retirement. Because the whole range of plans we see here, RSP, DB, DC, okay, are all limited in their effectiveness. So this is where we have these two alternate plans. Now, the IPP is one that some of you might have actually done or encountered. Essentially what it is, okay, all it is, it's a defined benefit pension plan for a small number of participants. I know it sounds like one. I think that some of you might really be questioning my ability to count to one right now, given that this is not the first time I've distorted this value. But anyways, the individual pension plan often does have one participant. This is common in an employee situation. But many business owners, and this is especially common for farmers, in family businesses, use IPPs for the whole family. And there you can have multiple members. Okay, so really what it does, it uses the actuarial calculations of a DB plan and requires the small business or the business to fund those actuarial promises. And the effect here is that it allows much larger contributions than an RRSP would. Okay, we will do a whole bunch of math. In fact, the math for this looks almost identical to what we did with the defined benefit pension. We'll do a whole bunch of IPP math in chapter 2 of it. Sorry, chapter 2. It can't. No, chapter 4 of advanced curriculum. Okay, that's good. But really, for now, if you know that about an IPP, you're in good shape. Okay, that's good. And really, what I'm doing here is I'm building an opportunity. Yeah, it's all registered, Philip. It exactly is. Yeah, I'm building an opportunity to really use more of your corporate dollars than you normally would to fund your retirement. Okay, that's good. Okay, and then I can have the RCA, or the Retirement Compensation Arrangement. This is a very complicated plan. And yeah, it allows high earners, and it's done for executives, that's true, business owners, and actually professional athletes other than NBA players who are contractually not allowed to do this, to build retirement income on a partially tax-deferred basis. And the upside here is that your contribution limits are based on a reasonableness test. versus your normal RSP limit. So for example, a $400,000 a year earner could have, let's say, I don't know, $80,000 a year going into an RCA. And that's going to fund their eventual retirement. Okay. That's good. That's all you really need to know about the RCA right now. So Esther, do you remember who was the very expensive person in my pension plan? Or in my defined benefit plan? Do you remember that? Okay. So my 50-year-old, Esther, in fact, the company had to put in more money than the RRSP limit. I didn't show you the math around this because I know we're going to do it later. Okay. Yeah, I have owners on there. I have business, third bullet down, Roxanne. You see it? On the IPP in blue, any business owners use IPPs for the whole family? You with me there? So, yeah, okay, so yeah, exactly, yeah. Right, so that's the point. Paul is right here, Esther. But remember, my 50-year-old was very expensive in the defined benefit pension, Esther? Remember that? So what I'm really doing here is I'm using that very expensive pension as a sort of excuse to use more of your own business's dollars to fund your eventual retirement. Okay. So a SERP just is any plan that sort of is doing this, Melanie. A SERP is any plan that pushes us beyond that normal kind of RRSP DBDC structure. Yeah. Yeah, and there are some others. Sorry, Roxanne, I need those spelled out for me. Or I need a scenario here. I honestly don't know what you mean when you say vestiture. Yeah, thanks, Jordan. I know. All right. Okay, thanks. Okay. So you wouldn't, Ksenia. You would set up an IPP instead of a DC plan. Okay. And in fact, you would almost never see somebody who has a DC plan and an IPP. Okay. Not really, Ksenia, but what would happen here is the employer is going to work with a pension consultancy, somebody like Aon or Morneau Chappelle, and the pension consultancy is going to say, tomorrow, Melanie, tomorrow they're back, usually early tomorrow morning. Yeah. So the pension consultancy, Ksenia, is going to say, okay, big company, for this group of people, you're going to use DC. For this group of people, you're going to use IPP. For this group of people, you're going to use RCA. That's good. So it's not really the employee who's making these decisions, unless it's the small business owner. I don't know. I need some context there, Roxanne. I don't know what that means when you say transition compensation.
Hi, Jason. I'll just come off mute here. What I'm wondering is a lot of different people that are in the industry, they're contracted. And so after so many years of being contracted, there's a certain percentage of transition commission that they pay out once you decide to leave the business. And so a lot of people use that towards their retirement as well. This looks like something that would be very good, what you're talking about here. But I was just wondering how that is supposed to be taxed, because I know that it's been done several ways in the past.
My guess with that, man, that's messy, because if they're really, like, you literally mean a contractor, or do you mean an employee?
Contracted.
Oh my goodness, those are such an, and honestly, in Alberta, Roxanne, we find all kinds of stuff done that is absolutely not tax compliant that way, especially in oil and gas. I assume that's what you're talking about here.
Yeah, it's been done so many ways. It's just hard to know what's the right way.
My guess is that I would do that as an EPSP. I think that's probably what it is. But the problem is that person's not an employee, so technically you can't use an EPSP. But what you're describing, it would be in this category. It would fit into SERP in general.
Mhm.
Yeah, I don't know. Yes, they do, Philip. Yeah. So both IPPs and RCAs have to be approved by CRA. Yeah. No, I have my employee on here as well. Second bullet point, Ksenia, often has one participant common for employees. You see that? Yeah, it just wouldn't be that they set up the IPP. The employer would set it up in that arrangement I talked about before with Aon or Mercer or whatever it is. Okay. You with me there? Yeah, okay, perfect. Okay, sorry, we're well over time here. And honestly, if you just know that the SERP is the sort of alternative to the traditional plans, that's good. Maybe not, Esther. I didn't actually say that because there's no universal answer to that. I like it, Melanie. I like it. A little stress is good. Okay, a little stress is good. Not a lot of stress, a little stress. Yeah, agreed. All right. Okay. Yeah, I do like this though. I think it's good to sign up now. It gets you in the right mindset. You'll have time to really get used to the idea of writing the exam. Okay. All right. And if anything goes wrong, you'll have tons of chance to address it. And you're more likely to get the place you want to write, and you'll get the early bird pricing. There you go, Paul. All right. I'm going to go do some landscaping. Okay. Thanks, everybody. Sorry for going overtime. You go to fpcanada.ca, I think it is, Todd. Okay. If you need help, call Kelsey tomorrow. She'll help you out, Todd. I am the wrong person to ask.
Yeah, I know. I called earlier or last week and she was busy, so I'll try again and see what I need to sign up for. So
Yeah, she's been super busy lately. So you can block a time for her to call you. She can do that.
Yeah.
Yeah.
It's okay. I worked all last weekend too, so
all right. Yeah.
super busy.
I
Okay.
know the feeling. All right, perfect.
See you later.
Not for CFP PEP Shade. You have to be done everything to sign up for PEP. Okay. All right. Yeah, that's true. Have a great weekend. Yeah. Okay. Yeah. All right. Thanks so much. Thanks for lots of great questions today. Really appreciate it. Thanks, Esther. Thanks, Melanie. That's good. Sorry for all your, oh, Rosalind's not even back on yet. All right. I'm going to stop the recorder here.